Hi everyone! On this video, I am going to talk about the different types of life insurances. We have the term life and the whole life. When getting a life insurance, it is important to do your own research in order to know which one best fits your needs. So it'll depend on your lifestyle, your financial situation, and your budget. Term life means that you're covered within a specific term, like say 5 years, 10 years, 15 years, whereas whole life insurance means that you are covered your entire life or up to age 100, as long as the policy is intact. Term life insurance. This is the cheapest type of insurance and usually gives the biggest coverage for what you pay for. It is also renewable. For example, you get a 5-year term. After 5 years, you can extend this and get another 5 years. You do need to know that in getting insurance, the premium or the amount you pay for the insurance gets higher the older you get. So this applies to all types of insurances. But if nothing happens to you within the term, which is of course a good thing, you don't receive anything in return. It's similar to insuring cars or houses or other non-life insurances. But of course, if something happens to you within the term, then you get all the benefits from your policy. What are the advantages and disadvantages of term life insurance? It has cheaper premiums with a higher coverage, and it may be convertible to whole life policies. A disadvantage is that you are only insured for a limited number of years. It does not have any cash value or dividends, and premiums increase every renewal. Whole life insurance, unlike term, you are covered your entire life as long as your policy is in force. There are two types of whole life insurances. We have the traditional and the VUL, or the variable universal life insurance. Traditional. These are non-investment linked life insurances but have equivalent cash values which you may loan from or pull out in case you want your policy contract to end. It also earns you dividends. This is an extra amount of money that the company earns and shares it to its policy holders. The amount though is not guaranteed. It will depend on the performance of the company. Here in traditional life insurance, you cannot add or make top-ups to your policy in order to increase your cash value or maturity benefit. VULs, or variable universal life insurances, are investment-linked life insurances wherein a portion of your premium is invested in designated funds which comprises of stocks, bonds, or money markets. This amount is not fixed and it will depend on the movement of the market. You may have gains, losses, or break even. Here, you can also do top-ups in order for additional investment. Depending on your account value and economic situation, the insurance company may ask you to pay additional premiums after your term of payment, and like for traditional, the premium you pay is fixed. So these are the differences of a traditional whole life insurance and a VUL whole life insurance. With regards to the cash value and account value, traditional gives you a cash value, wherein you can loan this amount of money, or if you want to pull out your policy, you can withdraw the whole amount. Whereas in VUL, you get an account or a fund value which is non-loanable, but it is withdrawable. You can withdraw a portion of your investment or your earnings, but you need to leave a certain amount in order for your policy to still be intact. You may also withdraw the whole amount if you want to end your policy contract. Traditional gives you dividends, whereas VULs don't. Both of these types of whole life insurances allows you to add riders. These riders may be hospital income benefit, critical illness riders, or accidental death benefit riders. Or some policies or plans have other different kinds of riders. Top-ups, traditional does not allow top-ups or additional premiums or changes to your premiums, whereas VULs do allow these top-ups in order for you to increase your investment. And coverage. The coverage is of course lifetime for both of these policies because these are whole life policies. Paying period for traditional, it is fixed. So if your paying term is 10 years or 5 years or 15 years, after that, you no longer need to pay any premium. Whereas in VUL, you may be required to add additional premiums after your payment term, because our fund value is dependent on the market or economic situation. Do know that it is not advisable to get VULs just because you want to grow your money or because of the investment portion. The reason why you're getting life insurance in the first place is to have peace of mind that you, your family, or your dependents are protected. The investment portion of VULs are just added benefits to your policy. It is not to grow your wealth, but for wealth protection. The advantages of whole life is that you are insured your whole life or as long as the policy is intact. It has a cash value or savings component. Depending on the type of whole life insurance, you get dividends or investments. Disadvantages, typically, its premium is more expensive than term and it is not convertible to term insurance. So this is a summary of the difference of term and whole life insurances. With regards to the cost of premium, term is lower than whole life insurances. Coverage versus premium, term gives a higher coverage versus the amount you pay or the premium you pay versus whole life insurance. Length of coverage, for term, it is limited to the number of years you got or the term you got, whereas whole life is lifelong as long as the policy is intact. Term life insurances doesn't have any cash values, but whole life does. Term does not give you dividends, but whole life does. Term has no investment component, and in whole life it does. Again, it depends on the type of whole life insurance you get. Term life is convertible to whole life insurances, whereas whole life insurances are not convertible to term life insurances. Riders, both of these types of insurances allows you to add riders or additional living or health benefits. What is best for you? It really depends on your financial situation, your lifestyle, and the needs of those people who are dependent on you. It doesn't have to be an either-or situation. Some people do both. They get term life insurances for affordability and they eventually convert it to whole life insurance. And some people do both at the same time. It really depends on what suits your financial needs. It is best to consult with your financial advisor so that he or she can help you decide on which policy best fits you. I'm a financial advisor from Manulife Philippines and I'll be glad to help you out. So that ends this video, guys. I hope you learned something. Don't forget to like and subscribe to my channel and hit the bell button to be notified for more videos similar to these. Thank you guys for watching. Bye! It also earns you dividends. It also earns